If AI is actually a big threat, then that is not positive for India. So India has underperformed by nearly 30% this year against emerging markets, which is the worst relative performance in 30 years.
So basically, you have this elimination framework that you use to outperform the index, let's put it that way, right?
So the logic is too easy for even a retail guy to understand. So for example, Yes Bank went from 12 rupees to 600 rupees. So in between, everybody would have made, every fellow in our country, every mutual fund, everybody has made. If you overdid it, you have lost. Because if you in the end said, no, I keep stocks for 25 years, sorry, it's gone back to zero. Cloud, basically the concept was started by Amazon. But that does not mean that in China, Alibaba guys didn't do it. I mean, some things you have to be able to relate that, okay, I will help these guys in other countries, but in my own country, if nowhere, if nothing else, at least all these things could have been done. Since you are in Bangalore, you are very kind by saying that we are lagging a bit. There is no comparison. We are doing exactly what we were doing 25 years ago.
So, Samir sir, number one, first of all, I'm a very big fan of you, and I've been tracking your fund for a very long period of time, and the way you track the markets as well. So, again, thanks a lot for giving some time and coming to this podcast. The first question I have for you, sir, is that over the last 1 year, Indian equities have basically lagged with respect to macro markets, right? Whether it's emerging markets or the Western markets.
Global.
Why do you think that is?
So first thing is that India, even including this underperformance for 1 year and more particularly year to date, has still outperformed over 5 years all markets other than US. So by all markets, we don't mean 100 countries or 200 countries. We mean Europe, Japan, China, Asia ex Japan, that kind of groups. So in that sense, you can say, why did it outperform 4 years so much? Bottom line is these are a continuum kind of a thing. But in general, India has done well 5 year, 10 year, 15 year. Now, if you say specifically 1 year, why has it underperformed? So there are 2, 3 reasons we can give. Number one reason is that this year AI led markets or markets where people could invest in AI stocks have gone up a lot. So for example, Korea might be up some 70% and Taiwan is up and even China is up some 40-50%. So that could be one reason. Second is that India got isolated July onwards by President Trump's policies that we are out there having a very high tariff. And that led to a lot of selling from July onwards. Actually, India did have inflows in March, April, May, June from FII investors because the background assumption is that the Indian mutual funds and institutions have money, even the public has money. It's the FIIs who are selling and a little bit of private equity led selling. So if one of those comes down a little bit, you don't have to fall or at least underperform as much as we have done. So India has underperformed by nearly 30% this year against emerging markets, which is the worst relative performance in 30 years. And third reason, you can say that last year was very tight liquidity, which now these guys are doing. Government is doing all these things on interest rate cut and income tax cut and GST cut. So therefore, some of it we will catch up, I hope, soon. Because generally 5, 10, 15, 20 years, we have done well. So not so many bad things have happened in 1 year for us to suddenly be last sort of in the world.
Got it. And have we decoupled a lot from the emerging markets and the Western markets?
No, decoupled means this year we wanted to be coupled because this year they are up a lot. So this decoupling is when it happens once in a while, we can say we have decoupled. But decoupling would be if their markets were down and we were not down, then we can say that our Indian institutions and our Indian guys have done it. So this is not this year is not a positive decoupling. It's a negative that we have decoupled. But in 22, we used to say we have decoupled because the US was down 20 and India was up about 2-3%. You can say we have decoupled, but it's not been worth it if that had been the case.
Wonderful. And sir, this year there was a lot of talk about China doing well. It was undervalued and it went up. I know a lot of global fund managers were also talking heavily about China, and yes, they are doing very well. Now, from a retail investor standpoint, a lot of people wanted to go buy the index through our ETF options that we have. Now, this whole debate about India versus China with respect to the market specifically, what do you think about this? Is it an opportunity which Indians should look at as investing in those ETFs?
There's no debate. China is very, very good, both as a market, as an economy, as the things that they have done in technology, blah, blah, blah. So I would think that Indian public should buy a little bit of US and a little bit of China. Yes, they should buy. Both these are top of their game in whatever way. And China, other than this 1 year, has underperformed a lot. Other than last 1 year, it's up some 60, 70%. Still, it would be down a lot for 5, 10 years, or relatively at least down. So yes, China can be bought. I myself own in our fund, other than a few stocks, you can buy their tech ETF, which has all these random, these normal big tech of China. Just like you can buy the NASDAQ 100 ETF. I think 10, 20, 25% can be easily invested outside if a route can be found, which is giving a representation of those things and not just randomly some China PSU fund or a China overall fund, because that'll give you many of these old economy stocks and banks and oil companies. So you don't want
Yeah.
that, I guess.
Got it. And sir, I mean, talking about the AI front, I think you said that people have moved their funds towards US because the whole AI race and the AI bubble is
US
going on.
and Korea, Taiwan, China, these are the
Yeah.
markets that have done well. So, what is the common thing we say it is AI? Who knows precisely why the FIs have gone? But these
Yeah.
are the obvious reasons they would have.
But what about our Indian IT companies, sir? I think this was a debate a lot of people were talking about. That Indian IT companies, with the balance sheet we had, I would say we were lagging a lot, and maybe even today we are lagging a bit from the global markets. So are we like skipping a step?
Since you are in Bangalore, you are very kind by saying that we are lagging a bit. There is no
Yeah.
comparison. We are doing exactly what we were doing 25 years ago, which is assisting
Yeah.
somebody else. And at one point, it was useful because you were assisting companies. So we can say if Indian IT companies helping levers, obviously Indian IT can't become levers. But when an Indian IT company starts helping somebody do cloud and somebody do these things which India could have done or these guys could have done, at least in our own country. Like cloud, basically the concept was started by Amazon, but that does not mean that in China, Alibaba guys didn't do it. I mean, some things you have to be able to relate that, okay, I will help these guys in other countries, but in my own country, if nowhere, if nothing else, at least all these things could have been done. But there was too much focus on cash flow and return to shareholders and all that. So, if AI is actually a big threat, then that is not positive for India. If it is, but if it is not, and it turns out that the use cases are not found, which means AI investments themselves are either too early
Yeah.
or waste. I don't think they'll be waste, but maybe too early. Then we have that much more breathing space.
So it's like we're taking caution.
I
Yeah.
can't understand that there is nothing else. What is AI supposed to achieve? AI can only achieve one of the following two. And since you are in Bangalore, you can give me the third reason. One is to do things which human beings cannot do. Okay, so
Correct.
that is a very noble thing, which is, let's say, I don't know, drug discovery or weather patterns or something, or some new metals, new something. What is the other?
Hmm.
To do things better than what human beings can do. What is the third way? What is the third reason to do AI?
Correct.
Second is
Correct.
to basically let machine do. Now, previously we used to think that this will affect white collar jobs. But now it is affecting blue collar jobs. It is affecting drivers. In theory, it is affecting drones for delivery. So all these things at the end are going to affect people, and we have the most people.
Yeah. No, I saw that. I think in US, when you see the driverless cars, it is unbelievable, right? The things like that are
And
there in reality.
we think that it cannot be done anywhere else, but it is already happening in China and it is on the road. In China,
It's
it's not under
unbelievable.
trial. It's already there. That means it can be done even in China type roads. That means one day it can be done in somewhere. And even if they are not done, from a market point of view, we'll think that these things can be done. The
Correct.
valuations go away of many things. If you think that 5 years later this will be impacted, if not today. But I'm not talking about driverless car. That is hardly a thing where our stock market is today interested. We are talking about IT, services, and what can be done there.
Awesome. So, sir, coming to Helios, right? I think you guys have had amazing performance. I think you posted on Twitter as well recently about it. And you have this
So, by the
elimination
way,
framework.
today we have completed 2 years. Okay,
Oh,
just
sir,
today.
congrats.
Or means yesterday we
Wow.
completed 2 years, you can call it. So, there'll be another
Super,
post for 2 year performance because that is also very, like, we
super,
are up
sir.
some
Thank you.
53, 54% or 52% or something in 2 years.
Wow. Wow. So this is the learning I want, sir, today. So basically, you have this elimination framework that you use to, outperform the index. Let's put it that way, right? So I want to understand what is this, elimination framework for the retail audience to understand.
Yeah. This is made for retail, except that we implement it in our institutional business. So the logic is too easy for even a retail guy to understand. If there are 200 companies in the index, because previously I used to have 200 companies in my index, and I used to think my job is to beat the index. Okay, many people think that your job is to buy the best company in the country. No, it is not my job. My job is to beat the index. Because you can't say, I have underperformed 20%, but I have the best company. They'll say, how do you say it's the best company? Nobody knows. The only thing we know is in Navy. So if there are 200 companies in the index, and I can identify 30, 40 bad companies on very obvious parameters, you could find five companies that are very expensive, which every retail guy will know they are very expensive. You look at P, you look at history, you look at whatever, how much earnings have grown, how much price has grown, it looks way off the chart. You can find five companies that everybody knows has very poor management because every day they get into some news or the other which you feel is, and you find five companies where you believe out of maybe 20, 50 companies of each kind which have very low growth, which currently are under pressure for something. Some two, three companies which are getting disrupted because you think this sector is getting disrupted. You find five, six companies where PMS guys and the press guys have written that they are bad accounting. You don't even have to do it yourself. Basically, you find the most egregious cases along different parameters: expensive, the valuation, growth, poor history, some disruption of the industry, some something or the other, and you remove only 30, 40 companies. Not all companies, not every bad company, not every expensive company, not every company which has very high debt, and you buy 150 companies out of 200.
You will beat by math.
Will you outperform the index or no? Because what I've done is I am not removing only one kind of bad companies. Because one kind of bad company, suppose I say I don't like high debt, which many people don't like. But you remove all high debt companies and say, see, I've cleaned up the portfolio. Now something will happen, some interest rates will fall. For 3 months, only the highest debt companies will be going up because they are the most benefited from this. Or you say, I only don't like companies which are confirmed frauds. Fraud means you will not find a real fraud, but you have bad history. You will not find more than four or five. There might be 30 out there, but you will not know 30. So to increase that, what I'm saying is instead of finding the good, it is easier to reject the bad because good, there is no end to what is called good. There's no definition of good. Their definitions are mostly of bad. For example, people say our company has very good corporate governance. Can you please explain what is good corporate governance? There's no such definition. The definition will be he does not cheat, he does not issue ESOPs, he does not do related parties. These are not good things that he doesn't do. It means he's not bad. So what I'm saying is, if you say what is good corporate governance, there's no answer. Because if you say he does not do all this, I will say, but does he care about management longevity? Does he make sure that everybody is motivated? Does he make sure this is respected? Does he make sure the board is? There's no end to that. And then we'll say, is it the MNC who you're talking about? The management means the CEO of the company, or the company, or the parent if it's an unlisted I mean, sorry, if it is a MNC. I can keep asking question to say that how do you know it is good? But to say bad, if let's make it easier, let's say you have to evaluate an employee. Try and prove to me that employee is good, there is no answer. If I'll say this employee harasses women, the story is over. You don't need to say, does he come to office on time? But if you say he
Yeah.
doesn't harass women, I'll say, so big deal. Does he come on time? You'll say he comes on time. And I say, but how does that help? Does he do his work? Then you say, I say, but does he get result? There's no end to this. But if I say he steals money, over, story over, you don't need to ask, does he harass women also? It is easier to know what is bad
Yeah.
than to know what is good. And in
Got
the
it.
end, there are 200 companies or 100 companies for somebody's universe. Instead of trying the best, remove the worst, you'll land this side. And the other thing is, I don't think that the good know how good they themselves are. That means, people say that we are betting on promoter. Sometimes the promoter also does not know that he's worth betting on. Because how does he know that he will be successful? For example, I am buying Zomato. The Zomato guy didn't know that day that he's going to buy Blinkit. And if
Correct.
you had not bought Blinkit, then Zomato could not have gone up like this. It would have gone to 80
Correct.
rupees. 100. So the
Correct.
thing is, we also don't know. He also doesn't know. Nobody knows. You think anybody knows all these things? No. Netflix guys went to Blockbuster Video to try and sell Netflix to Blockbuster for $50 million. You can type and see on Google. Now, why didn't they know that it'll be worth 500 billion? Because they don't know. We don't know. Nobody knows these things. How? But you can eliminate the bad and raise the probability. So that's why we call it elimination. You find factors. You can see our presentation. We have 8 factors. On that basis, we are eliminating, which is reducing the cost of error. You'll still find stocks to do badly, but the number of stocks that do badly should fall a lot compared to the market, and you will outperform. No, and because equities normally beat other things, fund managers cannot beat index, and index beats debt. It beats mostly real estate. Most of the time, it used to beat gold and whatever else you can do. And if you try to beat that index, that is enough. Don't get this thing that I have to do this or I have to do that. And index has 200 companies. If you're able to eliminate a few very bad companies, you will outperform.
Correct. And do you have like a concentration type of framework? He may 50 companies stuck, I will eliminate, or do you just eliminate the bad even if it's 150,
No, we are
170, you're okay?
eliminating the bad. Of course, if it became too much, that means this model would not have worked, right? Because this is a practical thing, it's not some theory. So we
Correct.
found that you can eliminate, not you can't eliminate everything and come to the final answer. No, no, no. It can't go that far. Because there'll be many companies who won't be able to find anything bad. Then you have to look for the good also. First, we are trying to eliminate the bad. But what is left behind bad is not good automatically. It is what we call not bad. Because if we say a company is not expensive, that does not automatically mean that it is cheap.
Correct.
It could mean that it is not expensive enough to be rejected only on expensive account. It could
Correct.
be normal. It could be a normal valuation in line with its history, in line with our market, in line with that sector. Then you see there's something else. So many companies cannot be eliminated, but at least you've eliminated the ones which were blatantly off the chart on valuation, or off the chart on growth, or off the chart on getting disrupted, or off the chart on history, or off the chart on being, the theme. Like we don't like, in most cases, companies where government is a large customer, and particularly state government. So mostly, if you have these state government guys as your client, then some area has happened. And secondly, sometimes the government changes, and then you have to do that second time, and then third time you don't get the project back because it's completely all these things. We have lost so much money on over a years that we don't do. So some of those only we are removing, and then we are trying to search for the good. So it's not that 100% you can straight away reach the final buy list by just eliminating. But by eliminating, you are reducing the cost of error by saying at least remove the howlers. And mostly the howlers have one or more of these characteristics. They are either from a sector that is getting disrupted, they are from a sector that is having very low growth, or they are very in a very competitive sector. For example, in Alliance, I used to be from the public market side, the largest shareholder in Bharti. Okay, this was 2000. Then we started Helios, so obviously because the same stocks we bought, so we bought Bharti. And Bharti has been one of my big success stories up some 40, 50 times. But after about in 2011, 12, or whatever, 13, 14, there were some 8, 10 telecom companies. And everybody knew that in the end, Bharti will survive because Bharti was that time also big and Bharti was doing a good job, but there are 8 guys. Now, even if you know that 7, 8 years or 5, 6, or whenever this ends, Bharti cannot be pushed out, doesn't mean I have to hold it for those many years. So we sold completely. After making so much money, they sold it to zero and said, when it's over, please call us. Then in 19, we bought it back, and from 19, we have it till now continuously. So, what is the point of saying? So, that's what we're saying. If it is too competitive, even if you think you know the end winner, unless you think the end winner is very soon, like 6 months, 3 months, 9 months, then okay, different matter. But generally, you remove some of these, your frequency of beating the market will go up, and then you will outperform. That is the
Superb. I think that's a very practical way to look at it. That's very nice. So I have one more question. Like recently, we're seeing a lot of high-profile IPOs coming in India, right? And you have, I think, from a fund perspective, also sat out on a few IPOs, and some you do participate as well. So I want to understand your take on what is going on with this high-profile IPOs. How are you decoding this?
No, no. So each stock is different. Each company is different. You cannot say like that. My simple thumb rule is, if you are a IPO coming at with loss type of situation, that you are at a loss, you're making loss, and you'll make loss for 1 or 2 more years, That is also okay. I don't. I mean, I am telling you the guys on Twitter because I now know the public view because I engage a lot on Twitter. People have no
Yeah.
idea what they are doing. Oh, this company is 1,000 PE. Oh, nonsense. They have no idea. But that is how the others outperform. But the point is, then you should be growing 40, 50, 60, 100%. Then don't come and tell
Mm.
us, I am making a loss, but I'll be growing at 15% or
Okay, got it,
20%.
got it.
That's no fun because 20% is a normal, not a normal growth these days because this growth is less. But it is
Yeah,
not a growth for a startup type guy. That means you are coming when the startup phase is over. So if
yeah,
you go 50, 60, 100% and you're making a loss, but we can see that this loss will decline because this will happen, margin will improve, and then 4, 5 years you can make serious money. That's a different matter. But if you're making a loss and you're growing 15, 20%, so slowly you'll make profit. One day, of course, you'll see that is boring, but then you can buy a regular listed company for a 15%. So, first thumb rule is you call yourself a startup, don't come to us at a stage when your growth rate has become like a normal company, but you are still making a loss, so you are being called a startup.
yeah.
That
Wow.
is
So you continue playing like a startup even in the public market. So the valuations will
no,
also
yeah,
support the
I
same.
don't mind that because you see, the guy who's coming as a startup into the public market, A has is a survivor because there were 30 companies, or God knows how many companies that were there, and we obviously can't do that because we are a public markets guy. So when you reach us and you still want startup type valuation, then you behave like a startup in the sense that you are growing 80%, 50%. I will look, then I will look seriously. And second is it's I think the public has not understood. I live in Singapore and I have understood it. I don't know why the Indian guys have not understood that food delivery and quick commerce has nothing to do with food delivery or quick commerce. It has to do with pollution, traffic jam, no parking, children having no time, parents busy. That is the bet. Why would you random? Everybody says, "Oh, I could have gone myself to the market and bought this for 100. I mean, I could have saved 100 rupees." I live in South Delhi when I'm in Delhi. Distance in the evening at 7 p.m., which if it was midnight or 1 a.m. in the morning, will take 4 minutes because it's like 2 kilometers. Will take you 40 minutes to reach your house from that coffee shop, which is 2 kilometers away. So I can go because it's 2 kilometers. Then you'll also have to go in that moped yourself in a 1,000 AQI. They might as well sit at home, give that poor guy 100 rupees and move on in life. They have not understood this, which I have understood that people are not doing it for getting things at home. They're doing it because it saves time, you save pollution, you save parking, you save driving. There's too many things. Anyway,
So
so what I'm saying
this
is,
is
if you can find the angle for that startup, that this guy is redefining how people are using their time and money, that is
that is important.
sometimes it is useful, yes.
Because you do invest in a good amount of, let's say, platform companies, and for retail investors it's very difficult to analyze
No,
platform
I
companies.
don't invest. All of them I have invested at 60, 70% down from their high.
Correct,
For example,
correct,
Zomato, we didn't buy in the anchor. We were not anchor in Zomato. It went from 76 to some 140, 50, and we bought it at 52. Paytm IPO'd at 2000 and we bought it at near 500. And then
correct.
car trade, I don't know what price the IPO was, but it went to 1650 or something like that. And then we bought it at 650. So
Yeah.
recently at this event, one guy asked me on stage that what is a good valuation for a startup? When I said when it falls 60% is a good, but maybe we
So
won't
for
get
you,
it again
valuation
now. But
comfort is important. Like, you know, the company is
no,
great and the future.
my point is because the stock is down 60% does not mean that you say this guy is a money loser. He ran away with my money. No, you guys bought it, somebody bought it, but it's not the end of the world when it is down 60. If you can separately see some progress that has happened along the way in terms of, I don't know, loss reduction or more acceptance by consumer or whatever. But who knows? It's not every, and all of them won't work as smoothly as these ones worked for us because it also depended. 22 was a bad year for the market, or 23, 22, whatever. So that time anyway, many stocks fell and so many things worked together.
Wonderful. So I'm going to ask you something a little personal. Okay. Everyone knows their, let's say, they have one big win that they always have in the back of their head. Every investor knows that, and one big learning that they had in their entire journey. So if you have any examples, that you don't have to name the stock as well, But any big win that you always remember, it does not have to be big in terms of monetary value, but it can be big in terms of some learning that you had in the past. And same way, some mistake or something that the market.
In the big movers, my NAV over 29 years is up more than 500 times. Okay, if I take to my job, so I've had many, but I believe, although what I talk public is always HDFC Bank because our fund bought it in the IPO, and across the two jobs, I have it even till today, and today also it's a number one holding. But it's not that it was number one throughout, but it was always in the top 5, 7 names, 29 years or whatever. So that is the example we use. But there have been many. I had in 2 years, a number one stock in our portfolio went up 100 times. But we can't enjoy the whole return because of the limit that you have. Like semi rule is 10%. Even I feel we should not have very high because new investors are also coming in. So it's not like a prop money that when we say it went up 100 times, that means whatever we had in the beginning, it went up 100 times and then we sold it. No, no, no. It means the first purchase to the last sale. If I buy today some stock and then, like I keep saying I bought Zomato at 52. If 1 year ago we got new money, we bought it at 100 and whatever or 200 and whatever. So I'm not waiting all these. I'm just saying from the first. So that way. So the lesson in that is that there are many stocks that do well, provided you don't try and say, I buy stocks for 30 years. If you say, I buy stocks for 5 years, hundreds of stocks do well. Because just think of the logic. If somebody says that over 30 years, say 100 stocks have gone up, very well, I mean, maybe 25% per annum or something. So that means in 29 years, more than this number went up because every stock was going up and then one stock couldn't do it. Okay, because it's got okay. So after 10 years, the number would have been much higher. Then some got burnt out, some had some problems, some got some very scam. So that means if you look at the period for 5 years, it is much higher by definition than the number of stocks that do well for 10 years. Because you did well for 5 years and then for example, let's say I used to own this company, Aban Lloyd. It's Aban Offshore. So Aban Offshore from 2004 to 7 went up 100 times. I didn't make 100 times, but the stock went up 100 times. And we made maybe in our Helios fund 4, 5 times. Out of this 100, we made 4. Some 5, 7 years later, the stock went to zero or near zero it is now. Okay. So if you look at the wealth creators, this company does not exist. But in between, it went up 100 times. And many people would have made maybe even 100, maybe not 100, but they would have made 30, 40 times, 20 times. So for example, Yes Bank. Yes Bank went from 12 rupees to 600 rupees. So in between, everybody would have made, every fellow in our country, every mutual fund, everybody has made. If you overdid it, you have lost. Because if you in the end said, no, I keep stocks for 25 years, sorry, it's gone back to zero. But otherwise, in that whole period, you bought it at 200 and you sold it at 400. Because if you kept your horizon reasonable and not, I never sell at 12 rupees, 15, 20, 30, 50, what was you didn't know what scam may happen or what may go wrong. Because they also didn't know. You think management knew when the stock was 40 rupees that something will go so badly wrong and I will do something so off? No, nobody knows, including the guys who may, if they have done something wrong, they also don't know that they will do something wrong. You can say they were aggressive, less aggressive, used to think all the time, but aggressive means keep a lower weight, don't keep it like HDFC, don't think of it as a 20-year hold. Keep of it as quarterly analysis. Thousands of people, millions of people would have made money, and then the rest millions would have lost. But the point is, as long as you keep the horizon, because anyway, if you want to keep the horizon long, the guys who have lost would still lose. Right? Yeah. Because you're keeping it long, everybody who kept it long would have to go because it has gone back. But if you kept it a little short,
you would have made
people
more,
would have made it simple arithmetic or logic. So
it's so weird because it's like now time is your enemy now.
Overdo this to 100-year horizon and 20-year horizon, nonsense of the highest order. Because everything has to go back to zero unless it gets taken out. Everything. So in the long run, everybody has to go to zero then. And all the wealth creators are actually of more recent times. If you see in the US, all these new companies have made all the money, no? So if you say 100 years, where are those companies of the olden times, the rail companies, the telecom companies? No, nobody exists. It is just the way of life. So to say I hold forever and all that. Anyway, so 3, 5 years at a time, and multiples of that means it's not that when time is over, okay, now I have to sell. You are looking at it with that view of a 2, 3 year horizon. It doesn't mean you have to sell. Don't overdo the thinking, and of course, there could be other way around, that you think this sector is gone, then don't do for 2 years, then don't do it at all. But most of the time, you will not know that this is under so much. For example, we keep saying we bought these banks, like particularly HDFC Bank and Kotak Bank, also an alliance. Now, I also don't remember, but it's not possible that I bought only these two banks. There were 5, 10 other private banks. There were Times Bank, Global Trust Bank, Bank of Punjab, Centurion Bank. Nobody knows where they are, and I'm sure I bought those also. But after 1 year, 2 years, I found nothing is happening. So you blew them off. So it's not that I only bought two banks and held them for 20 years. Nobody can do like that. So don't do that. On the other side, where we've lost a lot of money, and we have lost in every part that you can lose money, is that in most cases it was infra type investment. Infra type, which
Infra
means
type.
big project is infra only, but what I mean, it depends on what you call infra. What I mean is big projects. Government is the customer. The government doesn't pay you on time. Sometimes you don't get approval. Sometimes you get an income tax raid because you bribed somebody. This, that. So we have reduced it to eliminated it, kind of thing, you can say.
But this is some really good learning. This is super. This is super. So now one last question. Now you have seen both sides. Earlier you've seen how Indian retail used to operate. Now you are sitting on the opposite side of the table as a DII and FII. So what do you think that retail investors are doing wrong that maybe FIs and DIs are doing right in India?
No,
Like
first
when
of
you
all,
see it so obvious.
DII does not exist without the retail guy. Okay, so
Yeah, the average Joe.
I think in the last many years, DII has proven to be smarter, you can say, but actually they're same. What happens is, because the FI has sold India last few years, and the Indian market went up 15%, suppose, although it didn't this year. But so the public thinks, what fools these FIs are. They sold at 100 and they will have to come back and buy at 120. We will show them. Arey bhai, that fellow maybe went to Korea and made 170 out of it in the meantime. Who knows what they have done with that money? But even if he has to come back into India and buy at 120, our Indian public, particularly on Twitter, because that's where I operate, will get so this thing. These guys, you see, they sold 2 billion when index was 25,000 and they bought 2 billion when the index was 30,000. These bunch of losers. Nobody knows what China they bought or Korea they bought. So I'm saying don't think about all these things. Everybody is doing whatever they can in their own way. But the Indian guys have been way more steady than I thought. I used to say that the biggest risk in India is that because the retail public was new from 17 onwards, that when there is a fall, that fall will get accentuated because the domestic retail will also panic. Actually, they have not panicked because the returns from India overall have been very good, and therefore the public is not looking at 3 months, 6 months, and they have understood that over 2, 3 years they have made good money in any phase since the comeback, which is say 17. So therefore, there have been a stability. This thing. They have provided some calmness to the market. So I don't think that anybody is doing anything wrong because you don't know what the alternatives the other guy had.
Yeah. But what do you think retail investors should improve?
They could look at our fund more seriously.
Superb, superb, superb. No, I like it, sir. I love this candid behavior of yours. Superb. Yeah. So one last. Now we'll go to the rapid fire segment, as I call it. Very simple. I'll ask you a question, and in 1 minute you have to answer this question.
1 minute is so long. Okay.
Less than 1 minute. It is in less than 1 minute. Okay. First question to you. Why do you think FIIs are not coming back to India still?
So actually, it's only in the last 2, 3 years that they have not come back. Otherwise, if you look at 25 years, they have been mostly positive. So first big reason was that after 18, when India started this capital gains tax, that has also affected FII flows. But that, let's say now so many years have passed, so whatever they had to do, they have done. So this year, I think, has more to do with the fact that the other markets, that is Korea, Taiwan, China, had done very badly over the last many years, and that chance came for these guys to bet on those markets. So I think that is the reason. But in March, April, May, June, FIs were positive, and then the Trump tariff paid in negative. So once if this thing goes away, I think they'll be positive. Broadly, they are normally positive, I would think, as a thumb rule.
Perfect. The next question is looking at the recent internet companies that are coming with IPOs at exorbitant valuations, do you think it is creating like a big bubble in India for internet companies?
So, but which internet company has come? Internet company is what?
Let's not say internet company. Let's talk about high end valuation companies.
New tech companies or new age
New
companies.
tech companies. Yeah, new age
Yeah, yeah.
companies. Yes.
So it depends. We are also anchors in one of these new age companies, which is physics for her. Let's see what happens. Because we also want to try new things. The thing is, one thing is that fund managers who say that these companies are expensive should at least evaluate the company without the valuation. Because, okay, on valuation you reject, but they are changing the way things are being done. If you did not evaluate the quick commerce companies on the basis that it makes a loss, therefore there is something wrong. 2 crore people are buying from those companies every day. Their customers are 2 crore in food delivery. God knows, maybe another 2 crore guys, maybe it's the same guys. It changes many other things. For example, this restaurant business is doing badly because people are ordering at home. So if you own these 5 restaurant companies or these Westlife type companies, one reason is previously pizza was the only guy who could deliver you at home. So if there's a cricket match, you can eat pizza or maybe cook at home. Okay. Now you cannot chole bhature at home, so the pizza guy loses. It's in every sector like that. So they are all worth evaluating whether you buy or not, your choice.
Perfect. Okay. What are the top three things you personally check before investing in an IPO?
In an IPO. So in an IPO, the first thing that everybody wants is that whatever, if he's doing a new thing, that that new thing is actually apparent that what value it is adding. That this is a good point. Like he's doing this, this is a useful thing. Okay, this fellow is teaching for 4,000 rupees in a year. That can have a big market because even if somebody doesn't want to study, his father will say, "Bloody take 4,000." Maybe he'll see 1 hour, or you'll say, "Acha, he's delivering things at home, and from 8 p.m. to morning 9 p.m. all 9 a.m. all the other shops in this area are closed. So from 8 p.m. to 9 a.m. so you are 100% monopoly. I like this." And then you say, "Oh, AQI is 1,000. Oh, I love it because I don't have to go out. This is useful." So you have to first get that right. Then
Super.
they will show you, and you have to believe it or not believe it, that there is a path to profitability, that the unit is right, unit economics are right. But the reason we are making losses is because we may profit in one city or in one area, and we are doing the same thing immediately in another area. So that it makes the loss. But if we did not do this and we stopped at what we have done for the last X number of years, see how much money we are making. In all these cases, that is where the loss is coming from. That in the first place, wherever you started, or big cities or whatever, that you're already making money, but you want to grab that whole space, so you are spending somewhere else. It's like this. Previously, these hotel companies and hospital companies, if you had one hotel or one hospital, you're making a lot of money. Say, after 5 years, 7 years, you make a second hospital, the company is making a loss because the second hospital will have interest cost and depreciation cost, which is not, and then no profit because the first year revenue is only 10% because nobody knew you exist and all that. Now, will you say that the company should be selling at, why is it selling at 1,000? No, it's a sum of two companies. There is
Correct.
a existing hotel, and then there is a new hotel which you can take at cost because it is
Correct.
making a loss. But that loss, every guy who makes a hotel will make a loss for 2 years, 3 years, something like that. So if you want to combine everything, keep crying that, oh, this 1,000 p, this is 5,000 p. The world doesn't care. That's why the world buys all these things.
Super. Awesome, sir. So, one more last question. In the stock market, everyone has a mentor that either they look up to or they learn something from, right? And most of them have different mentors. Who is your mentor, sir, in so many years? Do you have someone
My
who you've learned a
mentor
lot
is this.
Oh, wow.
This.
Oh, my
Because
God.
every day,
Oh, my
every day I have a new mentor. Every day, even in
Oh,
my
my
bag,
God.
I keep books. When my NAV is doing well, that day I read books in office also. Because there are
Wow.
so many mentors you are getting for $20. You don't need one mentor. So when I read a Soros book, I used to read, I will start thinking and I will quote from that. Then I read a Buffett book. Then I read some Druckenmiller book, some book. Every book there's some story. But I can tell you in black and white that I have made serious money just from reading books. I mean, obviously you're talking and you're doing. I'm saying the trigger, the last line. That comes because I'll tell you, forget. I've said this in the past that I made money from reading this book Chip War, and I made 8 times on Nvidia because that book you can't read and not buy Nvidia. If you are You also have to know the market. Today, if you read it, you should not buy it. But there's another book I read on shenanigans in accounting or something, accounting shenanigans. And I realized, oh, same thing our cable guys in India are doing.
Oh
So
my
many
God.
shares. So what they would do was that suppose a cable, you are saying that I'll give this box to you for free, like they said, na? That if you take a 24-month subscription, 36-month subscription, you will get that cable box. You don't have to pay whatever 200 rupees a month you're paying. The cable box is like you're not paying for
Paying
that,
for it.
charging for that.
Yeah.
But they would charge you some 500 rupees service fee for the guy to come. So we used to say, okay. Then I read this book and realized what a scam that is. Because what would happen that 500 rupees they take as their revenue.
Oh my
The
God.
box cost 2000
Oh.
rupees. Okay, so box cost 2000. So basically, they are giving a 1500 rupee box for free because it's a 2000 rupee box. They are collecting from you 500. So there's a 1500 rupee subsidy plus that guy has to come. The worker has to come home to fix it or whatever. Something like that. So actually, you are losing money on day one. But day one, they will show not, if suppose 999 they are charging. So they'll show 999 revenue because they took 999 from you and then they'll pay 200 rupees to that guy who came home to fix it. So they have a profit that day of 700 rupees. Now the 2500 rupee box will be written off over 36 months because it has a 3-year life, something like that. So the actual economics is on day one, you lost straight away 1500 rupees because you took 1000 or 999 and you gave a box of 2500 plus you spent money 200 rupees on that guy. Completely different. Of course, you can know on your own, but either or some mentor can tell you, or the book can tell you. There are many
So what
places.
are some three books you're reading right now, or maybe just read
So
that was
right
nice?
now, I'm still not finished 1929, which is
Okay.
being written by Andrew Ross Sorkin, the guy who wrote Too Big to Fail. Because in
Okay.
between, I read the book on Zomato, which is called it. What is it called? It's live here.
The
Unseen,
Kindle was
unseen,
unseen.
unseen. Very
I just
good.
got it.
It's a
I just
beautiful
got it
book,
today.
and you can see that how easy or difficult it is to do these things. These things are not easy. So that book I read after I've started 1929 because this book is easier to take around India when I was in India last week. So I finished it. Unseen, very good book. And please read and decide for yourself. So in between, I read, but otherwise, my master book that I'm still reading is 1929 till I finish it in maybe 10 days, 5 days, whenever I'm
Yeah.
ready.
And sir, anything online you read, like you follow some blogs or you follow some nothing
Also,
online?
blogs and all, they're not
I think
much.
someone interesting who writes some good stuff
I
like
know, but
online.
I have to. There's no time these days. There's too much
Hmm.
things to be done. So I don't read many blogs. No, unless somebody forwards them to me, I'm
Yeah.
not going anywhere.
Yeah. Perfect. Perfect. Awesome. I think Samir sir, this was it. I think I got a lot of information from you.
Thank you very
But
much.
again, I think Samir sir, one thing I'll tell you what I loved, right? You have simplified, and obviously it comes with experience of so many years. Because in today's world, a lot of people like to complicate investing, right?
Yes.
They will have so many big jargons and say, "ये करो, ये करके index beat करेंगे." आपने बोला ऐसा कुछ मत करो बुरा
कुछ
वाला
नहीं करना है,
तो
ये सब खानीबाजी है। अब मार्केटिंग है उनकी, अब क्या करें? अब हम भूल
yeah,
गए।
exactly. That is why when you come and say like let's remove the bad guys, and you see automatically by math you will beat the index, and I mean obviously that makes sense,
Yeah,
right? So that is the
one more thing is that if a retail guy says that he bets on management, he should laugh at himself in a room. How did he know that management? Or because I saw his interview with CNBC, which was 7-8 minutes, or I saw YouTube, which was edited 23 times, and that also maybe 30 minutes. And if you don't have paid Google, you'll have to see 25 ads in between. So how you're assessing quality of management? But bad things you can see, read, and make an inventory from any articles, any blogs, any PMS guys writing on why it is bad. You also agree that it's bad. It's okay.
yeah.
You have to
But
just
that is
reduce
what
the
I love.
universe.
But again, Samir sir,
Thank you
thanks a
very
lot. I know
much.
you're a very busy man. Again, I
Thank
would
you.
love to someday meet you and have a coffee with you and just learn from you off camera, right?
Absolutely.
Whenever that's
Singapore is open for you. Thank you. Thank you.
done, sir. Done. Thanks a lot, sir.